did our interim audit in May. During the interim audit, it included a full inventory count of all warehouses, so we had to organize that across multiple departments. During the inventory counts, our auditors observed. We also conducted internal control interviews. I believe 2 board members were selected. So Estrada was one of the board members. I believe yourself as well. Various testing procedures were done from the audit firm and no issues were noted during the interim audit period. Field work for the audit is scheduled to conduct September 2nd through the 12th. This is when the majority of the auditors do their testing. So during that time frame, up until that time frame, we're making sure that all AP invoices are posted to the correct fiscal year and period. Invoices are due by the end of this week to ensure that we can accrue them. Finalizing our capital asset entries. So last year we booked 175 capital assets. That's a huge push for an agency. Currently we're at 109 assets and we're still booking. So we'll probably get about up to the 175. Key upcoming dates, the audited financial statements target date is December 1st. The state controller's report will be due January 31st. And then the single audit report is due March 31st. A lot of prep work goes into the audit, not just at year end, but all year long, with the heaviest effort between July and November. Now I will turn it over to Brandon Young, partner at LSL, and his team to provide an overview of their role as the external audit.
It was Brandon, you said?
Yes.
Everyone, you guys hear me okay? Am I here?
Brandon, I think you can mute yourself and we should be able to hear you.
I am unmuted. Can you hear me?
Brandon, can you hear us? Okay, so audio is not coming in. Yolanda, the audio from the presenters is not coming into the room.
Yeah, trigger it.
Testing.
Yeah.
While we're waiting for those guys, I have a question. Why is it referred to as a single audit in the staff report? And it's only mentioned as a single audit issue one time, and the rest of it is mentioned just as a audit.
So we have an annual comprehensive financial statement audit, which is the whole agency. And then the single audit only audits our grants. So they're looking at our only grant related functions.
So the single audit issued by March 31st is grants.
The separate report and separate audit in addition to the comprehensive audit.
Testing.
They try to conduct them at the
And
same
what is the
time.
final audit issue?
It's December 1st, that's our target date.
And our drop dead date to still apply for the GFOA award would be December 30th. We're trying not to work over the holidays if possible.
It's just odd that they have different dates.
Different components, different so like the interim audit focuses on internal controls and what the district has done to date for the fiscal year. Final audit focuses on the actual numbers, data, pulling samples, and then we issue the comprehensive financial statements with the audit notes and the numbers. And then at the same time, we do the single audit, which is focused on the federal funding for all the grants, but that audit is not due to the state until March 31st. So we try to do it sooner. We also have the state controller's report. It uses the same data, same information, just different reports to different entities with different deadlines.
Thank you. I was curious about that.
And the single audit report, actually, while we keep waiting for Brandon.
We can hear him on Zoom if it's only Zoom, but we can't hear him in this.
The single audit reports gets issued to like the WIFIA agency, the state controller, State Water Resource Control Board, our banks, so anybody that has the external debt, they always get that. And attached to the single audit report is our comprehensive financial statements.
Oh, good.
So sometimes they get those twice because they also want the actual comprehensive financial statements. So they'll get them in December and then they'll get them again towards March with the single audit report.
And that's also why the due date is later, because you have to have the first audit complete and the financial statements.
That's why it's 26. Okay. That makes sense. Thank you.
But if we can't hear Brandon, he's gonna check now that sense. And the link is just on the home agenda page.
Can we get any of the presenters to?
You know, it's something going on in Zoom because they can hear each other. So all the participants can hear each other. We
They
just
can hear
can't-
us.
They can hear us.
We're just.
We just can't hear them in before. So there was issues.
And then
We all get on
Yeah,
that.
They don't have feedback.
Might have to go to join Zoom there and then only server, I mean, because we can only hold about 10 of
All the pieces.
Your haircut looks good.
Thank you.
Yeah. Good.
Can you ask Brandon?
Brandon,
Can you try saying something again?
Yeah, testing.
There we go.
we can hear you now. Thank you.
All right, yeah, no problem. I always laugh because we've been doing these meetings now for 4 or 5 years virtually, and then we still struggle on our end too, so.
Thank you all for your patience. I think we're good to go. So, Brandon, do you have a PowerPoint or anything we need to be showing, or is it just verbal?
No, just verbal. The kind of Carla and Sammy were chatting a little bit about what we were going to talk about. So I'll just kind of reiterate what we said. The summertime is a slower time for our audit process. Online also is Riley and Vinny. They are the managers and the in charges for the engagement. You don't need to add them. They're listening though. So they are here. So kind of as Carla and Sammy mentioned, we're the external auditors for the district. This is our second year going into the audit. Last year, I think that there was some turnover. Sammy was new. We were new auditors. So last year was not how we wanted it to look. So we've got kind of a game plan for this year to have a good timeline, get things ready to go and hit that December 1st date. So I think both the district and us are excited about that. As you guys were talking about, there also is a single audit component. So as Carla mentioned, that's for any entity that receives over $750,000 in federal funding. The number will be going up to $1 million here for fiscal year 26. That won't impact many agencies, as that difference is pretty small if you're getting large awards, but something to keep in mind. If you do fall under $1 million in future years, then you will not trigger a single audit. As we mentioned, the goal is to receive the GFOA award, like Carla mentioned, is due by December 31st. And then the federal kind of statutory deadline, which requires a financial statement audit, is due by March 31st. So in reality, the ultimate deadline for any government agency that has federal funding is March 31st, because the federal agencies want your single audit report, which is focused strictly on compliance, as well as your financial statement report kind of submitted at the same time. So that's a little bit on that part. So as they already mentioned, we've already completed interim. Interim is focused on processes. So we are getting an understanding of the processes related to cash receipts, cash disbursements, tracking grant activity, capital asset activity, taking kind of best practices from the industry and making sure that the processes the district has in place would catch any errors or fraud that were to occur before auditors finding them. So that's a focus on interim. In the summertime now, we're doing our risk assessment. So risk assessment is taking our understanding of the district, any external factors, maybe new federal award programs, anything in the environment that could affect the agency, and then we're designing our year-end procedures to complete in September and October to be able to kind of pull details that Sammy mentioned. So we're confirming bank balances, we're testing bank reconciliations. A lot of time is spent on capital assets, which Sammy mentioned, testing grants, any long-term debt. Doing a search to make sure that expenditures are recorded or expenses are recorded in the proper period. Doing analytics on kind of revenue items, verifying rates. It's really a wide variety and a lot of questions and a very comprehensive year-end request list that we send. I think we're very much on track and on a good track for this year. So that's for this year's audit cycle. And then also I kind of mentioned the main change this year for when it comes to accounting pronouncements is GASB 101. So GASB 101 has to do with compensated absences. So compensated absences has always been recorded on the financial statement. So the change now is they are, to keep it high level, they're adding a component to essentially estimate sick time that has been used and any other types of leave. That's not typically cashed out upon an employee leaving, but you have to estimate how much you are going to pay out kind of over the course of them being here. So it is going to add a liability to the agency's books. Liability is already there, but it's going to increase it. And there is a little more detailed calculations than there has been in the past, where historically compensated absences has just been, okay, what's the cash out value of your vacation bank when those employees leave? Now they're adding, okay, what's that plus your estimate on how much sick time or whatever they're going to use over the course of their employment here. So it's not as big of an undertaking as the leases and the SPIDAs, if you guys recall that the last couple of years. But it is a little bit more analysis, and it will add some items to the footnote, hopefully clarifying it. In the footnote, historically, you see there was an additions and deletions to the compensated absences as well as a beginning and ending balance. Now it's just going to be a net change, and not an additions and deletions. So that actually, I think, helps clarify it, as one of those numbers was hard to come up with anyways. So that's the most pressing one that's this year. The other one's coming up. There's 102, 103, and 104. So 103 is probably one that would affect the agency the most. That one is the financial reporting model. So there are some changes related to enterprise activities and how certain things are disclosed on the income statement as well as the MD&A. That one takes effect, I think, for fiscal year 27, I want to say. I might be 26. Let me double check on that, but it's not for this year, so that'll be in the coming years. And then they're working on disclosures for capital assets, land held for resale. They're assessing the need for any like going concern disclosures for governments. So there's definitely nothing on the pipeline that is as massive as kind of pension, OPEB, leases, and SPIDAs. But they're always trying to keep themselves relevant and trying to kind of enhance financial reporting for governments. I recently I'm on the expert panel for the ICPA, so we had a liaison meeting with the GASB board, and they're very receptive actually to kind of changes and feedback from governments about what actually is useful and what is not. There was a lot of discussion on going concern for governments. Does that really make sense? And there was there's always been discussion on leases and SPIDAs. Did it achieve what was intended? So the main things on the pipe are revenue recognition, going concern, and then capital asset disclosures. They're looking on some things for infrastructure reporting as well, just to kind of keep you guys updated in the loop. But I think that GASB 101 will be less time and less labor intensive, so that will give us on a good track, good audit cycle this year, and hopefully the next year is moving forward, and it'll be hopefully pretty status quo and smooth sailing. So we're excited to kind of have a consistent team on our end and both in the district, and looking forward to this year. And getting on a good track. So I don't know if Carla, Sammy, or any of you guys have questions or anything else you wanted to mention.
I did.
No, I didn't hear that there was anything going away though.
No, unfortunately, no. I wish that they just got rid of some of them, but they are here to stay. It's possible they kind of, make some enhancements and improvements in the future, but it's unlikely, as they sort of have to keep themselves employed.
Thank you.
Thank you, Brandon.
Thank you.
All right, I'll talk to you guys soon then. Thank you.
Yes, we have Chandler next, and we have Elaine joining us virtually to provide the presentation. She'll also be doing the board presentation as well. And then we also noted on the staff report that we are keeping an eye on any investment policy changes and updates. So there's 2 Senate bills that we would require some minor amendments to our policy, but nothing big, and we'll be bringing at the next Finance Committee meeting the draft of those changes, but wanted to make note of them today. Do you have a presentation for this one? Elaine, can you hear us?
Hi, it's Elena. I can hear you.
Perfect. All yours.
All right, thank you. And so for the presentation, will I be able to see it, or should I try to show it myself?
Can you not see it on the Zoom?
The Zoom says order of business 4 discussion items, and then just lists the three discussion items, with Chandler presentation being B.
They should be able to see it because I changed it on my end.
Are you present or are you board? Which one are you? Board. You're not showing any.
I'm sorry, present. No, I'm, I don't even know.
No, it's not. It's showing the room.
It's showing in the room, is that what I heard?
Yes.
Yes.
I can proceed with that. I have the slides in front of me, so I can tell you what number to scroll to if that works.
That's
Sure.
great,
Thank
thanks.
you.
Thank you.
Okay. So again, thank you, everyone. My name is Elena Marie Sampson. As Carla stated, I work for Chandler Asset Management, and we are the investment advisor for the district. Appreciate you having me here today. As part of that brief economic update and portfolio review, I will speak to what Carla referenced with regards to the two minor changes to code. So if we could flip to slide 3, please.
Yep, got it.
Okay, great. Thank you. So the economic data overall has come in a bit weaker, and Fed Jerome Powell's commentary has indicated that interest rates would be lower if there weren't so much uncertainty around tariffs. So where are we with the tariffs? I think that's the big key that is driving markets right now. We are in the negotiation phase. We are negotiating with individual countries, as you're hearing on the news, because a lot of those larger tariffs were postponed from July 9th to August 1st. So here this week, we're looking for a number of deals to come through. Meanwhile, we're also negotiating with the courts for what is and is not legal to be done by executive order. There is an appeal hearing that is scheduled for July 31st. So we're all anticipating that. And then the big one is China. That is the one that got up to 145%, effectively a trade embargo, and that's paused until August 12th. Though I will note, for anyone who shops on Temu and Shein, you will be disappointed that the de minimis exemption has been eliminated. Looking for other tariffs that are still in place, one is the 10% universal tariffs. You'll hear that called the reciprocal tariffs. Anything not compliant with USMCA, those tariffs are at 25%. USMCA, if you're not familiar, is the new name for NAFTA. Autos remain at 25%. So we're hearing a lot of US makers actually be impacted as they provide their results for the second quarter because of these tariffs. We're also seeing aluminum and steel at 50% tariffs. And then this month, we've started hearing a new term thrown about, tariff letters. And these letters are threatening new high tariffs to a broad set of countries: Canada, Brazil, South Korea, and for a number of different reasons outside of what is typically used for tariffs. I'd note that geopolitical tensions are also having effect on markets with the bombs that were dropped on Iran. That increased oil prices by 10%. They have since come back down a bit, but we are still seeing them a bit higher than where they were. If we go forward to slide number 4, please. What we're seeing from an unemployment perspective on slide 4.
We're here.
We can see it, Elaine.
Okay, you're on slide 3 right now, so, or at least online it's showing slide 3.
We're on slide 4. They're fixing the Zoom.
Got it. Thank you. Okay, so I'll just keep calling out numbers and then hopefully we'll all get synced up. So the labor markets are a bit tricky. We're seeing a net migration as it starts to decline. We expect that to have an impact on U.S. labor supply. And what we're seeing through revisions is the U.S. is continuing to add jobs, but on a slower trajectory. So that's on the employment slide. For June, what we see specifically, the total non-farm payrolls was increased by 147,000, which was above consensus, but our unemployment rate declined that down to about 4.1%. Here in California, our unemployment remains the top part of the top 5 in the nation at 5.3%. But there in Riverside, I'd note that your unemployment rate has been declining from the start of the year at 5.3% to now 4.8%. As I took a look at what's happening in your county, which is a bit different than the rest of the state, you've been benefiting from some growth in tech sector, additional population growth, as well as some of the construction and related industries. So that's helping your unemployment rate to be a bit lower than what we're seeing in the rest of California. If we move forward to slide number 6, that stated inflation, what you see here on the page is an update. Inflation, the most recent read for June, came in at 2.7%. So it actually went up from where it was in May at 2.4%. And core inflation, which strips out energy and the more volatile areas of CPI, that increased to 2.9%. So we're going in the wrong direction. But I'll note that inflation impacts were expected to be seen near because that would be about 3 months after the tariffs implementation. So this is only slightly above what expectations are. The big question that we have today now for the Fed is, will inflation be a one-time shock once these these tariffs hit, or will it be a long series of increases? So it's really hard for us to tell at this point, but we have seen a nominal tick up in inflation in this June reading. If we move forward to the consumer, consumers did pull forward quite a bit of their spending into the first quarter, causing the second quarter to be weaker. And you're actually going to see this when I show you the GDP slide in a moment. Though I will note, you may have seen in Wall Street Journal article highlighting that consumers are surprising to the upside again. And what I'd point to is that this is all speaking to the mixed dynamics of what's happening. We're seeing higher income or higher wealth consumers. They're starting to reemerge this summer, and they make up the majority of the dollar spend in the country. But what we're also seeing simultaneously is that auto delinquencies are back to pre-pandemic levels, and consumers, as a count of the population rather than the spend, are pessimistic about the future impacts on pricing because of tariffs. So it's a bit of a mixed bag right now with where we are from the consumer's perspective. So I just mentioned the GDP. So if we jump forward to slide 11, I'll show you that number. And there, what we saw was that pull ahead of purchases, people seeking to pull ahead their purchases. You can see net exports and imports was a negative 4.6% in the first quarter. And that was companies and individuals seeking to get ahead of all of those tariff prices. I'll tell you, I did a bit of an experiment myself, made a few purchases in the first quarter to see what those prices would look like. And indeed, a number of the goods that I purchased were increased by, again, with the Shein and Temu, up by 30 to 70% that month later. So definitely was an impact there on pricing, though, again, that was a more focused reason for it. So overall, what we saw was a negative 0.5% GDP in the first quarter of the year. That was the third release on that information. If we flip forward 2 more slides, what does that mean for bond yields? What we've seen at the first half of this year was that the first quarter was dominated by everyone impacted by the tariff announcements. The second quarter, the news story was about the One Big Beautiful Bill, which was the story to watch in the second quarter. And that truly started to drive a bifurcation in yields, what you see on the left-hand side. What we saw was the 2- and 5-year yields started to decline a bit on expectations that the Fed funds rates would be cut. However, because of those increasing expectations of added debt and the added deficit and consequently added debt, we saw the 10-year yield start to move upwards. And so after the signing into law on July 4th, what we've now seen here in the third quarter of the calendar year is those yields above beyond 5 years starting to increase slightly. So I'm taking a breath before I move to the portfolio update, which is on subsequent slides. Okay, so if we could move forward a couple more slides, we're now at slide 15. I'll just reiterate that the portfolio is aligned to preserve the safety and liquidity of the portfolio while earning a rate of return that's commensurate with the 1 to 3 year benchmark. This portfolio also has the option to purchase securities with maturities up to 10 years to opportunistically lock in rates. And this report that I'll go through also includes funds that are managed directly by district staff. So if we can go forward to slide 16. I'll note that the portfolio is in compliance with both state code and your most recent investment policy. As mentioned, there are 2 changes that are working through the legislature to legislation to be effective January 1st if passed. Both of them are related to commercial paper, which is what you see toward the bottom of the page. One of them is to extend sunset provisions for that commercial paper, namely that you can have up to 40% in commercial paper. Your portfolio currently has 0%, so it doesn't really impact you greatly, but this will be an added option if the district has additional liquidity needs or other more short needs. If you're not familiar with commercial paper, you can think of it as corporate bonds that mature in less than 397 days. And on that point, the other bill is a bill that would extend the district's ability to purchase those commercial paper up to 397 days, because presently you are limited to 270 days. So those are the 2 provisions in California Government Code that, if passed, would be effective, affecting your investment policy. So moving forward a couple pages to slide 19, your portfolio characteristics. This is where we get into how are things actually going for your portfolio. And if you can't tell by my voice, I am smiling. We are continuing to maintain a duration that is slightly longer than the benchmark at about 105% of the benchmark, really to make sure that we're staying ahead of those expected lower rates coming from the Fed fund cuts. And your purchase yield benefit from both the post-liberation spread widening. So that announcement of tariffs that took place on April 1st was named Liberation Day. So after that date, we have seen widening of spreads beyond the US Treasuries. And so we were able to add asset-backed securities as well as high quality corporate bonds at attractive levels when new issuance resumes in April, May, and June. You can see those purchases later in the packet if you have that in front of you in around slide 48. But on this slide, what you see is the purchase yield increased from March from 4.2% to 4.33%. And this is in an environment where the market yields, what we would be able to purchase, was actually declining. So positive there with what we were able to do with the portfolio. Overall, your average quality is at double A plus, which is in line with the US government, and your total market value increased by about $7 million to $525 million. That comes from not only the increasing income to the portfolio being generated, about 5.4 million for the quarter, but also because of those declining market yields, there's an inverse relationship between yield and the value with the marketplace. For the fiscal year, for anyone who's taking notes here, the total amount of income earned was about $20 million for the fiscal year. If we turn to the next slide, the sector distribution, in terms of asset mix, we were also seeing value in Freddie K's. On this slide, you'll see that sector categorized as agency CMBS. That increased to about 10%. And that value we're referring to is Freddie K's are the Federal Home Loan Mortgage Corporation, and so the federal agency. You could pick up between 30 to 40 basis points, that's 0.3%, above corresponding US Treasury yield. So we really saw that as another good value and wanted to pick that up within the portfolio, add a little bit more exposure there. Turning to slide 21, as I mentioned, we also talked about the fact that this portfolio can purchase securities beyond the 5-year limit for beyond the core funds. And this, as I mentioned earlier, does benefit the portfolio's purchase yield because we were able to lock in some securities in that 5 to 7 year range for about 2% of the portfolio. So again, locking in yields for many years to come that are at very productive rates. Going to slide 22, the duration distribution. Comparing this to the benchmark, the district's portfolio has ample natural liquidity, which will provide an opportunity to reinvest at market yields or have the optionality to support the district's cash flow needs when necessary. All of this creating an opportunity on the other end of the scale to be able to lock in those longer term yields. So truly utilizing all the tools available for investing with these operating funds. Going to the next slide, on to the issuers. And I'll note, while we don't have any concerns with the names in the portfolio, one name that we're just keeping a closer eye on, and this is on slide 24 at the bottom, is United Healthcare Group. This is just a name that's been very much surrounded in the news since December, when Louis Maggiano was accused of shooting the CEO in December. Since that time, there's been headlines about the changing of the CEO, as well as Department of Justice investigations around Medicare charges, which that latter comment is actually something that's happening around industry. But just because of all that headline news, it's a name we continue to watch closely, and is a small part of the portfolio, but nonetheless, we believe it's important to let you know it's a name we're watching.
I have a
Slide-
question.
Sure.
So several of these, I noticed earlier, several of these issuers are listed as trusts.
Yes.
If you could explain to me the distinction between a trust issuer as opposed to, like, I noticed Bank of America is trust and American Express. So what is that distinction between that and just a regular Bank of America investment instrument?
Sure. So the Bank of America instruments that you would see would be issued directly by the corporation. So it would be a regular corporate bond issued by either the holding company or the operating company of Bank of America. And so that would show up under the corporate section. All the ones that are listed as trusts are various asset-backed securities. So these are various issuances that have been repackaged as a particular asset-backed security that then has other securitization credit enhancement. So oftentimes they will have additional letters of credit. They will have additional backing by that corporation in order to fund it. So slightly different security types, but just gives you a sense that the funds are separate from the corporation and helps to pay down that associated asset-backed debt.
Okay, thank you.
Quite welcome. Okay, so continuing forward to slide 25, please. The quality distribution. This is the one major change you'll see is the downward movement of ratings for Moody's. And Moody's had placed the US government on negative outlook back in November of 2023. So this was not a surprise by market watchers of this downgrade. And the downgrade was driven by that limited progress in really addressing the structural spending issues, including mandatory expenditures. We've certainly seen political federal gridlock, which in their opinion is hindering fiscal reform at the federal level. And moreover, there's been a very large increase in debt over a decade. So this isn't a political statement by Moody's, but really looking across administrations that the government debt and interest payment ratios are significantly higher than other similarly rated sovereigns. However, they did note that their stable outlook reflects the continuing exceptional strength of the US credit quality, as well as the strong institutional features. So across the board, what we now see is all US government treasuries, as well as the federal agencies, are now rated AA+ across the 3 credit rating agencies. So lastly, with regards to this portfolio, the investment performance, in terms of how this is translating, it's really positive. If we look at it on a fiscal year basis, that 12 months number, you can see the portfolio earned 5.96% on slide 26 versus the benchmark at 5.82%. On a portfolio of $525 million, that 14 basis points of excess performance translates to nearly $750,000 extra dollars to the district. And since inception, the excess performance is 30 basis points higher at 2.12% versus the 1.92%. So all of this is being done with very much a sleep at night portfolio. You can rest assured that we're not in anything scary in the portfolio, and really making sure that safety and liquidity is at the top of our thoughts. So in terms of the rest of this packet, what you'll see on slides 27 and 28, this are the portfolios that are managed directly by the district. There's a bit higher holdings in CAMP at fiscal year end as to support some large cash disbursements that are anticipated in July. The district does continue to earn a purchase yield that is competitive for these liquidity portfolios. Your WIFIA Stormwater Reserve account, which is on slide 29. This is 100% invested in the CAMP Pool product. Again, a very competitive return. And then lastly, what you'll see slides 31 to 33, altogether, your accounts amount to $719 million for the portfolio across all the portfolios that are managed by Chandler, as well as those internally managed by district staff. The balance of the slides are holdings and transactions.
Yeah, all right, so there's 195 million of other besides our main account, right?
Yes.
Between the 525 million and the 716. Can you just give us an idea of what that is?
Carla, are you able to speak to that? I can tell you that what what it's invested in is largely capped. So if you go to slide 28, you can see that it says LGIP there. It's 96.85% is within the LGIP. And for more specifics on what that looks like from a holdings perspective, I'm going down further. Go to slide 45. Please, you can see this is the reporting account, and you can see there's 2 CDs for $5 million. There's a little bit in LAIF at $1 million, a little bit in the Riverside County pool, and the balance is really in the CAMP product, both CAMP 174 million and then CAMP Term, which is a more structured product at 10 million.
Yeah, thank you.
This one is actually missing one of the BMO CDs, and so we'll be correcting that for the board agenda
Okay.
item.
So, I mean,
Slightly
obviously, I'm just trying to reconcile the asset, right?
Difference.
And so what is this other account? 11092, what is that?
The CAMP account,
I'm asking you, what
Mhm.
asset is it? Where does it show on our balance sheet?
it's part of our cash, like our
So it's
account.
part of our cash. So the 525 million is separate from this.
Yes, separate from these investments.
All right, so it's,
So this is the money we have, like more liquid money where we transfer in and out to cover our expenses. We normally don't have such a large balance, and so we did contemplate sending additional funds. Remember last year we sent like 10 million and maybe another 20 million to Chandler for long-term investments. We didn't do so at this point in time. We wanted to see, we have to pay down the PARS, the CalPERS payment. We have a lot of insurance payments we're paying down. We also are monitoring really closely our capital improvement projects, seeing how far we can utilize our cash before having to do our debt issuance, which we'll talk about
okay,
during the next agenda item.
just going on memory, because I'm not
Okay.
referencing another document right now. But I've never seen a number that high.
It has not been that high. I think the highest we've had is 165 million
No, I know, but
Not quite
if you
that.
put it all together, you're at 716
total,
million.
yes.
I've never seen anything near that, ever.
I think
I
a
mean,
lot of it
that's
has to,
150 million higher than any number I've ever seen.
it is pretty high. I think, but it has to do a lot with our capital improvement expenditures not being quite as high as we anticipated them to be with our budget process. We have a very large balance in the state water project account.
So these 716 million, they're all shown somewhere in some fund,
They're a combination of all the funds that we have.
right? So you add up all the cash and all the funds, it adds up to 700. Does this include OPEB?
No, this does not include
'Cause
the
that's a
OPEB, that
different-
is separate.
Yeah, so this is all the other stuff. This is all the cash.
And we keep a close eye on our current bank account to make sure that we send money there more often.
I get that, but I'm just wondering why I've never seen this number.
I think maybe for budget, because that's the number we usually show you, so maybe that's part of it, because I'm just looking at our table, so we're in that 560 million range is what
That's
you normally.
that's what
would
I'm
give
used to
us.
seeing.
And that doesn't include any of the developer fee funds, things like that we do have reserves, which I want to say if we add those all up, it's probably close to 100 or so.
I mean, even looking in the general manager report every month, I don't see this number.
Yeah, it's in the financial treasury report. It would be this number.
Maybe I didn't
Close
look.
to
It would include the OPEB trust as well. It's quite a big number.
Okay, I have another question for guest or speaker here. So
Yes, please.
one of the slides, a recent slide, you showed a total rate of return of 5.96%, which sounds high. On an earlier slide, you showed a market yield of 4.05, and I know there's another one that's the purchase yield, but can you tell me the difference between the market yield and the total rate of return?
Yes, absolutely. So if we turn to slide 26, that's where the 5.96 total return is. That includes not only the changes in market value, but all of your interest earnings and realized as well as unrealized gains and losses in the portfolio. So it's the total amount truly that the portfolio has earned in that period, realized and unrealized. That's the 5.96. So you're benefiting from the fact that market yields are declining. So to define market yield and purchase yield and the differentiation there, going to slide 19. Well, I'll start with purchase yield. The purchase yield is the average purchase yield of every single security in the portfolio. So securities you purchased 5 years ago at a given purchase yield, averaged all the way through to what we purchased through June 30th of 2025. That is the average purchase yield. You can think of that as the historical price, or excuse me, historical yield. The market yield is if we were to purchase all of the securities in the portfolio as of June 30th, the $525 million, what would be the market yield of that portfolio? And it would be 4.05%. So it gives you a snapshot of what are yields today if you were to sell your entire portfolio as of that date of the report.
Okay. So how did we get our, I think I know, but I'll want you to answer it. How did we get our total rate of return almost 6% when everything we're buying is closer to 4%?
A couple of things. It's actually because the market yields have come down quite substantially. So if you recall back in, late 2024, we saw market yields at about 4%, and we were locking in quite a bit of our securities at that above 5%. We were doing some work of barbelling the securities, meaning purchasing long securities at rather attractive rates, as well as short-term securities at above 5%. Add all of that up, and the interest that was generated from that really helped increase the overall portfolio earnings over the course of the fiscal year. Add to that, as the year went by, we continued to maintain a purchase yield above where the market yields were, which again has benefited the portfolio. And then the last part is a part of just the math of as as market yields decline, you see market values increase. And that's just the dynamic of the math of how market values and market yields have that inverse relationship. So it's really 3 different ways: the active portfolio management, the market dynamics of yield and price, and then also a mix of how we were purchasing across the fiscal year.
Yeah, and so that last one, for the total rate of return being 5.96, that includes unrealized
Correct.
gains. So as the rates drop, your value of the portfolio goes up. And you're not
Correct.
necessarily selling those assets, but you're showing what the value of the market value of the asset is.
Correct. So it's both the unrealized, to your point, yes, the unrealized and realized earnings in the portfolio.
Okay. The numbers look good, obviously. These are good numbers. I still don't know how we got to 716 million, but we're gonna figure that out. I didn't.
Here's the
Yeah, there it
June
is.
report.
Yeah, May 31st.
Right, 749. And this does include the trust,
Yeah,
but it's 740.
so take out the OPEB trust.
Right.
You get pretty close to
Pretty
that.
darn close.
That was a month earlier.
So this was May,
Right.
so it lags. This was the June report. We just gave this to the board.
No, I know. So this is, and that's June 30th. So
Right.
they're close. Yeah. Fair enough.
So I have a final question. So you came to the board a few meetings ago. We made some changes in the liquidity investment options. I'm curious about how you feel about, was that the right decision to make, and are you getting the kind of returns that you wanted?
We added the BMO CDs in order to get the lower letter of credit rate for our CIP projects. They're doing well. One of them matured. We reinvested it to continue to have that relationship and ongoing commitment to them so they continue to service at that lower rate for the letters of credit. the letter of credit cost would be substantially higher if we did not have those two CDs invested with them. We did withdraw the interest and just left the initial principal in there. And they do have very competitive rates that they're offering.
Okay, good.
I keep doing that. We are watching the camp investment, and Chandler and I, we speak every month, and they've made note that they're watching it as well. You're right, it's never been as high as it is now. I think it's down to one, maybe
70,
right now.
yep, plus the 10
Yeah.
million turn.
So, but we withdrew just the other day, like $40 million to cover a lot of expenses that we do have in July. So July is our heavy month. We have an influx of money, if you recall, from property taxes that come in May and June. Then we have a huge influx that goes out in July for state water project and risks, liabilities and insurances. And a lot of our software renewals are also due in July. So this month is a heavy outflow of cash. So we'll recalibrate in August and maybe send an additional 10 to 20 million to Chandler for investment purposes. The sweet spot, I think, the last time we did a year-long analysis on camp was about $40 to $50 million for liquidity. So 185 million is quite high at this point. But we'd want to work with Carrie very closely from engineering to make sure we don't have an influx of capital costs going out, because those can fluctuate significantly as well.
Right.
Great,
Okay.
thank you.
Thanks.
So that's a wrap on Chandler?
It's a wrap.
Thank
Thanks
you
a-
very much for having us.
No, thank you.
And then
Room 6.
6,
different
fund financing options. This is interesting. I looked at it. It's all new to me.
And David will be.
Sure, I can start out, and then we got Darren Hodge and Fred Dilly on the phone to actually give the presentation. But as we started back in conversations, I believe in February this year, we were talking about debt and reserves, things like that as well, coverage. And Darren was with us at that time too, as we were looking at the refinancing we needed to do for the USDA projects and things that was completed. As far as the adopted budget for domestic this year, we adopted a budget of about 68.8 million, which included about 2 million in plan or design for Chrome 6 as they're starting to look at the options for this. In May, engineering gave that presentation on the options going with, or recommending the alternative D option, which in the staff report, it just talks about the details, but basically the high level details is approximately 350 million in new need. 4 new treatment facilities, treatment at 11 existing wells, 4 new wells with treatment with 14 new wells, and then 1 well rehabilitation, and then existing ion exchange upgrades of 15 facilities, and then 7 storage reservoirs, and about 1.9 miles of transmission line. The CIP, as it was presented to the board and adopted, was about 245.5 million for the 5-year period. It did not include these costs at the time. And so this is the first presentation of looking at what that layering of additional debt service or what the financing options would be. So with that, I turn it over to Darren.
Thanks, David. Good morning, everyone. Can everyone hear me?
Yes, sir.
Yeah.
Perfect. Just wanted to make sure. So if we turn to slide 2, as David mentioned, what we wanted to do today was just begin talking about potential financing options to the extent that we need to borrow money in connection with the Chromium 6 treatment, which we're kind of referring to as the project here. And based off the most recent estimates that we saw, we're assuming a project cost around 350 million. So that includes project costs, contingencies, and certain allowances. Now, one of the steps, as we're aware, is the actual timing of these expenditures and the actual amount of the project cost are going to continue to be analyzed and refined as we move forward. And so as these processes and analyses are performed on the finance side, we're going to be working together to really refine and look at various options as it pertains to finance plans. So if we turn to slide 3, anytime we look at a large project, we're really looking at debt as kind of a last resort, if you will. We want to look at what opportunities do we have for PAYGO funding as well as grant funding first. And then to the extent that there are shortfalls in those funding avenues, then we'll look to financing. And anytime we look to financing, there's a variety of considerations that we like to look at, some of which we've included here as some of the more pertinent ones, such as the timing of the financing needs, how much we need to borrow. If we borrow, how much capacity do we have for debt? And then once we borrow, is it affordable for the district as well as our ratepayers? Kind of going hand in hand with that, how much would we need to increase rates to pay for this debt? And then lastly, what are the rating considerations? If we were to issue this much debt and based off our projected debt service coverage, what impact, if any, might that have on our ratings going forward? And if we turn to slide 4, currently the Domestic Water Fund doesn't have much debt outstanding on it. It's really just the 2025 A notes that are outstanding in the amount of about $35 million. And those are the notes that we were discussing with you earlier this year that matured June 1st, 2028. These are the notes that the long-term goal is to take these out in large part with the USDA loan, so fairly low-cost debt. And what we've shown down here at the very bottom is what the expected debt service for our current debt on domestic water would look like. And these gray lines, the first 3 years through 2028, that's the interest on the notes that we're expecting to pay. And then what we've done is we've estimated what the debt service on a 30-year takeout under the USDA loan would look like. And so once we take that out, estimated in 2028, our annual debt service cost will be about $2 million a year. And the reason that I wanted to go through this is because if we turn to slide 5, one of the important things to keep in mind is that as we look at any financing needs we have for this project, the amount of the borrowing that we need to undertake is going to have some pretty significant impacts on the overall debt service cost to domestic water. And what we've shown on this slide right here, if you look, we've tried to layer on different size borrowings on top of our existing debt service, just to give an idea of scale of how high debt service may increase. And so what you see down at the bottom here in gray, that's the existing debt service. So that incorporates, as I mentioned before, what the USDA loan debt service would be going forward after 2028. But then on top of that, what I've done is I've stacked on debt service, which represents different borrowing sizes. So the blue bars represent if we only needed to borrow $150 million, how much would debt service in the Domestic Water Fund increase? And then likewise, the yellow bars on top of that 100 million, if we borrowed another 100 million, you see our debt service would increase to about $15 million a year in that fund. And then lastly, if we ended up having to borrow the entire 350 million, what you can see is that our total debt service cost would be around $24 million a year. So it's a pretty substantial increase in our overall debt service obligation. And the last thing that we've added here is this little red line. What that represents is our fiscal 2024 net revenues. And those are the net revenues that under the bond documents are pledged to our repayment. And so you can kind of get a sense of scale in terms of how much net revenues would need to increase in order to be able to pay off the debt service from some of these different size borrowings.
So just to go back to your
ahead.
comment about affordability.
Yep.
Rates. I'm just keeping the numbers round. Take the 24 million and you figure you have 100,000 customers, that comes out to $20 a month, I think. 240 a year. Right? So that bar, the 24 million number, I know we're already doing some of it. We're doing 2 of it already. That bar equates to roughly $20 a month on a domestic water bill. Something like that, you know, I'm just trying to get the order of magnitude. Okay.
Scott, right now, we estimate the average customer is around $20, $24.
The average water bill is, given their consumption is closer to 40.
40, okay. Because the consumption is around 18.
Yeah.
PCF. I mean, it used to be
Yeah.
20.
Plus the meter, yeah. I mean, just trying to get a sense of what we're talking about.
Well, we've said about a 50% increase in the domestic rate, so that'd be.
Yeah,
about
that's
right.
about,
Yeah,
I mean, that's kind of where it is. Okay, go ahead.
Yeah, no, absolutely. And one other thing I wanted to mention on this slide is that this assumes that we issue all of the debt in a single year and that we structure the repayment to be equal annual payments. You know, there's ways that we can customize the structure of our debt, and we might issue it in different tranches over time. So this is a little bit of a more conservative approach. And the reason I bring that up is because as we move forward in terms of developing potential finance plans, one of the things we'll be looking at is perhaps kind of developing a glide path in debt service up to what our final debt service payments would be. And what I mean by that is in the early years, 29, 30, 31, as an example, those years our debt service payments might be lower and increasing gradually to our longer term higher debt service payments, really with the idea that if we do need to increase rates, to your point, Director, that it would be done in a way that's perhaps scheduled over time to do that. If we turn to slide 6.
Darren, just one more thing on this slide.
Yes.
This also does not include any of the already scheduled debt issuance. We have about 37 million that we're scheduled to issue for Sun City, Talavera, and I believe a reservoir and booster station. So that would be an addition to
Is that domestic?
within the domestic fund, yes.
Yeah, and honestly, $20 a month was maybe a little bold. So you could
Yeah, a
probably,
little higher.
you could probably fit that into the $20 a month.
I will make note to come back with an answer.
Yeah.
So our intent is to every meeting, finance committee meeting, explore these options and take back questions and come back with answers, really to build upon the knowledge to then ultimately come up with a determination best course of action based on, you know, when the state actually approves a plan and
Well, here's the
our
problem.
key project.
I mean, I don't know what percentage of our customers, but I know there's a good percentage, maybe 10, 15, 20%. They can't afford $20 a month. That's a problem. You know, I don't know what we're gonna do about it, but that I think we need to keep that in mind. I know this is not a discretionary item, but you know, how we manage it to make it work for our customer. I mean, I don't know the answer to that. There's a real problem here with how people are gonna be able to afford this.
These are also, I think, good data points for Scott Britt and his team when they go to legislative discussions with their analysts, is to have these data points. If we issued 100 million, what is that? That equate to on a monthly basis and so forth. So we'll take that back as homework and give you an answer.
Yeah, I mean, a good 20,000 customers can't afford this. That's a lot of people.
Well, our ability to use the discretionary non-rate revenue to buy down some of this gets complicated when we look at what's happening on the Colorado River. Maybe happening to the canal.
So we're obviously in this situation with a lot of other agencies, public agencies. So are we in tune with what other folks are looking to do in terms of financing options and maybe doing some sort of a group financing or some way to lower these costs? Is that all being looked at?
We have been talking with the other local agencies through the, I'm gonna get this acronym wrong. Joanne, please help me. Coachella Valley Regional Water Management Group. Yes, okay. To see if there's any synergy, also talking about just communication methods, and because we have a lot of the same developers in our area, and so that could potentially be an option. Sometimes that's a challenge when it comes to disclosures and who's carrying the actual debt, who's doing the ratings. Not all agencies are rated the same, and it could lead to a lower credit rating. We know the city of Coachella just got a put on watch. So we can certainly continue to have those conversations.
Yeah, I just, you know,
with
we're
the
not
other
doing this in a
agencies.
vacuum, so it's clearly we're doing that, but also for our financing team, I think.
Yeah, Darren, are you working with any other agencies kind of in the same situation for Chrome 6?
Not necessarily on Chrome 6, but obviously there's PFAS treatment that a lot of entities in California are dealing with. Yeah, I think you kind of hit the nail on the head, Carla, in terms of group financings, you know, debt issued through a regional GPA. That's something we can look at. But ultimately, I think us being as highly rated as we are want to make sure that if we did participate in anything, that there's a meaningful benefit to us versus, borrowing on our own.
Yeah, another thing to kind of keep in mind is we are the largest agency, we have the largest impact because of this in the state. We've got about 33 wells, I think, that need some kind of work. And I think the next one is Los Baños at 14 wells.
14, right.
So we're twice as big as it. And then after that, it just really drops down into single digits. But those are smaller agencies, don't necessarily have the capital capacity to even do a handful of wells without having huge local rate impacts. So we're somewhat fortunate that we're so large, but at the same time, because we're so large, we're probably not going to get any help at all from the state. Aaron, back to you. Sorry.
No, absolutely. Great discussion. So if we turn to slide 6, we'll start jumping into several of the different financing alternatives that we have and will continue to look at. I think one of the most important factors that we're going to be thinking about is, I think, as we're all aware, over the last 12 months, looking at the different financing alternatives, the interest rate's obviously incredibly important because that's going to be, at the end of the day, the additional cost that is passed on to our customers. But the other thing that's just as important is future financial flexibility. And so a large part of that goes down to legal terms. And so with our strong ratings, we have access to a variety of different borrowing options. The first is public debt that we've used in the past. The second is the private capital markets, which is what we used when we went and borrowed from JP Morgan earlier this year. And the last is the state and federal loan programs, whether it's WIFIA, SRF, the Cal iBank, et cetera. A lot of different ways that we can borrow if we need to. Now, one of the things that's very common with large projects is that you have a basket of financing and funding sources for large projects. So it's not uncommon to see a mix of cash, grants, together with either one or more various forms of financing to form the overall sources to meet the uses for our project. And this isn't necessarily this graphic, this isn't the letter of the law, but in general, what we look at when we try to figure out what's the best approach for us is we look at the interest rates, we look at the timing of when we need the funds, we also look at legal terms. And from an interest rate perspective, in general, going from the highest to lowest interest rates, bank loans are typically the highest rate, then you go to public debt, then you go to WIFIA loans, and lastly, SRF loans are typically your cheapest cost of funds. I will say that right now, as we'll talk about, WIFIA loans are more expensive than both public and bank loans. But again, this is in general based on what we've seen over time. Second, we look at closing timing because we need to match when will we get the funds versus when we need the funds. And in general, the SRF and WIFIA loan programs typically take the longest, anywhere from 18 to 36 months to secure the funds. Public bonds, typically we can get our funds anywhere from 3 to 5 months. And then bank loans are the most efficient from a timing perspective. We can typically get those funds in about 3 to 4 months. Now, as I mentioned, legal terms are incredibly important. That's something we really look at carefully because when we enter into an obligation, these are the terms we're going to live with for the life of the obligation. And in terms of most to least favorable, with public bonds, we are able to dictate the terms that we want to borrow at. So in large part, we're able to describe, here's the terms we want to borrow at, and then the rating agencies give us a rating based off those terms, and then investors make a decision as to whether or not they want to buy our bonds based off those terms. Next, I would say that WIFIA loans is the next favorable. WIFIA in general, EPA is amenable to using most of our existing terms, with obviously they have some caveats in there that they have minimums that they're willing to well, not minimums. There's certain terms that they cannot go more flexible than what their statutes dictate. Thirdly, bank loans are probably the next flexible. And then in terms of the least favorable terms, this is where you get to your SRF loans. Those terms are typically the most onerous for an entity like the district with strong ratings. And we saw that in the last 12 months where we ran into some potential issues with the SRF loan and domestic water. And so you can kind of see there's a trade-off with some of these different types of financings. You may get incredibly low interest rates, but the downside is that you may lose some future financial operational flexibility. And so we have to weigh all these things together when we're developing our plan of finance.
Darren, just
Yeah.
that, your third arrow on that graphic, can you flip that upside down? Because you got the other two where your best thing is on the bottom, and then on that one, you got the best thing on the top.
Yeah, no, good point. Yes, we can definitely do that.
Counterintuitive for me.
Yep, we will do that.
Yeah. In case we use it again. I don't know.
Any other questions or comments on this slide? Okay, why don't we turn to slide 7? Just going to go into a little bit more detail on the benefits and considerations of these various forms of borrowing in the public markets, the private markets, and then the federal and state loan programs. So in the public markets, this is when we borrow money, we issue debt, and we allow the public markets to bid on and purchase our debt. So these are the large bond funds, professional and retail investors that we sell to. And the primary benefit with a public market borrowing is, like I mentioned, typically we can customize our borrowing terms to really what we want. And in large part, that's what our bond counsel has done, is they've developed very flexible documents from which we can borrow. In addition, the predictability of when we'll receive those funds is pretty predictable. Typically, we can be in and out of the market in about 3 to 5 months. So that makes it very efficient from a timing standpoint. Now, one of the main considerations is that when we look at interest rates, a public market borrowing may be more expensive than some of the alternatives like SRF loans. And so when we compare public market versus all these other options, again, kind of going back to, we're looking holistically at what fits best for us, not just today in today's market, but also 5, 10, 20, 30 years down the road. Now, on the benefits of a private placement, again, this is the type of transaction that we did with JP Morgan, where we don't offer bonds to the public. Instead, we go directly to a bank. The benefit of this is that you have lower issuance expenses. You typically don't need to get ratings. You don't need disclosure. So it's very time efficient. We can be in and out of the market in 3 to 4 months. What are some of the downsides of a private placement? Often the terms of the loans may be constrained. Most lenders, they don't want to go out past about 12 years, and they may not be willing to lend $350 million. They may be a little bit more in the $50 million range or lower. And so it may not be kind of our one-stop shop for long-term financing. And then lastly, the federal and state loan programs. Historically, these, both WIFIA and SRF, have been low interest rates. In addition, they're very flexible in terms of the funding that they provide during construction. What I mean by this is that on the WIFIA and SRF loan programs, we only pay interest on the amounts that we've drawn. And so if we have a 5-year construction schedule for a large project, as we draw down those loans, we only pay interest on what we've drawn down to date. You contrast that versus the private placement and the public markets. On those borrowings, we start paying interest the day that we close those transactions. So even if we haven't spent funds, we're still paying interest on those unspent proceeds. So there can be some inefficiencies that come along with that. Now, the downsides with, or not downside, the considerations with federal and state loan programs, just the timing. From the time that we submit an application until we actually close the loan can be 18 plus months. Oftentimes it's 2 to 3 years in my experience. In addition, these programs are competitive. There's no guarantee of receipt of funds. And in addition, we may not have the ability to secure all of the financing that we need. For instance, under the WIFIA loan program, we can only borrow up to 49% of eligible project cost. So with the $350 million program or project, if we need to finance more than $175 million, we would need to go to an additional source of financing besides just WIFIA. And with the SRF loan program, right now, the size of those loans is being capped at around $50 million. So similarly, we'd have to have alternative financing for the remainder of the project cost. And then the last consideration with the federal and state loans is the potential impacts of federalizing the project. So, making sure that we're in compliance with Buy America, Build America, Davis-Bacon, et cetera. Any questions there before I move on? Okay, why don't we turn to slide 8? And again, we're gonna kind of peel back the onion one more layer and go into a little bit more detail on some of the key terms and provisions of these different borrowing methods. So in terms of interest rate, what we did here is we just compared what the rate would be in today's market for these various sources. So for a public market borrowing, 30-year level debt, you're looking at an interest cost of about 4.6%. You contrast that with some of the state and federal loans. You can see the SRF quite a bit lower at 2.1%. And then the WIFIA loan program was actually higher at about 4.97%. Now, I don't have a rate in there for private placement only because there is no publicly available index of what a private placement would price at. It's really subject to the lenders or the banks' targeted interest rate that they'd be willing to lend and for how long. We've talked about timing in terms of the execution time for each of these. The next one I want to talk about is rate covenant. And this is very important because it gets back to the terms and conditions of the borrowing that I referenced earlier. With the public market and private placement, typically when we're setting rates, the minimum that we're able to set rates is 125% of the net revenues for that given fiscal year. Now, that's pretty similar to what we get with the WIFIA loan program. The one difference here that we need to point out is that the SRF loan program has a different rate covenant that we'd have to comply with. Whereas in these other alternatives, we're only setting our rates based off 125% of that year's debt service. For SRF, we're actually having to set it at 125% of the maximum annual debt service for the next 5 fiscal years. The reason that I want to point this out is because if we remember back to slide 5, where we were showing the pretty substantial increase in debt service, the SRF loan program, given its 5-year MADS rate covenant, would actually potentially encompass these future years where debt service steps up fairly rapidly, and it would require us to set rates and charges today based off those future debt service amounts, even if they weren't actually going to be incurred for 3 to 5 years. So it reduces some of our potential financial flexibility and our rate setting flexibility for that reason.
So I get that. I mean, my eye goes immediately to the 2.1%. And I mean, it seems like if you can layer that in timing wise towards the end, and your overall debt service is going to be lower if your rate is half of what those other alternative rate are less than half. It just seems like we need to figure out a way to make it part of our deal, but try to be strategic about it. I mean, I think it said earlier that it takes longer to get it anyway, so you layer that in at the end, maybe.
Depends on how you structure the initial debt, because if that's a step up rate as well, and then this is an addition every 5 years, and does that gets recalibrated every 5 or every year, right? To add the additional year, Darren?
Yeah, that's right. It's a rolling 5-year, and I think the challenge that we're going to have is that it's not just 125%. And I said net revenues here. I apologize. That should be debt service. My apologies. It's not just debt service in the SRF loan. It's all debt on that lien. And so even if we put the SRF debt service at the very tail end, which we can't do, SRF actually requires us to have level annual payments. But even if we could, this provision would still encompass all of the other debt that we would need to sell, and would have to set rates based off that aggregate debt service figure. But I think your point is well taken, Director, which is that interest rate is very low. And so there's strategies that we could look at to figure out how can we potentially use SRF. Maybe it's a multi-lien debt service structure where we issue subordinate lien debt for everything else other than SRF. Is that a way that we can use SRF in concert with these other funding sources without potentially having this rate covenant make it more expensive for us in the near term from rates?
Yeah, okay.
The only thing I would point out is that this is, if we use those sources there, as you point out of the slide, those are based on reimbursement.
Yes.
And we had some issues, I think, or complaints, I think I've heard about usually reimbursement program financing sources, so. But given the interest rate, I think that would be avoidable. Yeah, that's just a comment. Go ahead.
Yeah, another important aspect to consider with all of this is going forward, what's our ability to repay this debt ahead of its maturity? Not just in terms of if interest rates get lower, but from time to time, we run into situations where it may be necessary to pay off or refinance the debt because the legal terms and conditions are not allowing us to do something that we need to do. And so the optional redemption or the prepayment features are very important. Essentially, most flexible with the public market and the private placement options. WIFI is also very flexible. You can typically pay that off at any time. The SRF loan is less flexible. We are unable to exercise that prepayment at our discretion. We can exercise it, but it's at the state's consent to allow for that prepayment. So there's some considerations as to how we would get that consent and whether or not we would actually get that consent if needed going forward. So again, it's part of this overall package of making sure we weigh low interest rate together with flexibility as we move forward.
Aaron, one other thing I think it's probably important to consider is right now, I think we're looking at a 10-year timeline to implement this project to completion. And so we don't need 350 million at the start. And so we've got to kind of consider cash flow based on how we're going to march through the different aspects to implement the construction timeline. And so I don't know, at one point, I think you said the SRF loans are at 50 million max. So, I mean, are we looking then, if we were to go that way, we'd be looking at a series of different separate SRF loans? Are there restrictions against that?
Yeah, it's a good question. I'm not sure, to your point, if we had a 10-year horizon, could we apply for an SRF loan up front and then a second SRF loan down the road? That's something that we'll have to check into. I don't know the answer to that.
I mean, if you have a bridge loan
Right.
to get you
Right.
to
Right.
50 million.
But I think the point is a very valid one, which is important to when we're developing a plan of finance. Timing is going to be critical because what we don't want to do is, if for a 10-year project, we probably can't, if we want tax exempt bonds, sell all of the debt today in the public market, tax exempt, and just sit on those proceeds. And so a very important part of the plan of finance is going to be, when do we need the funds? And then figuring out, based off when we need the funds, when and how much do we need to borrow?
Right. Okay, thanks.
Yep. All right. So if we turn to slide 9.
Just one more point, Darren, at the bottom there on the right-hand side. I did ask Darren to put this in because we have had challenges, going back to Director Aguilar's point, of, fulfilling the requirements for the state and federal loans. Kerry has quite a challenge in adjusting the scope, the project pricing, and every time it requires approval by these external agencies, which then delays the project. And so with the other borrowing, the private placement or the public market, that is not an impediment, but just wanted to point that out. That
I mean, are we talking about a
Statistic.
bridge loan to get us through the early parts of these things to, that has the more flexibility in terms of payoff date, et cetera?
we could potentially, right? There's also interfund loans. We could take a look at that as bridge financing. Just depends on legal approval. We want to have some consensus there from if we utilize our other rates. We did have the line of credit, the 25 million. We did let that lapse because it did have about a $16,000 quarterly cost, and we weren't utilizing it, and we didn't think we needed it in the next month. That's starting the next year. But potentially, yes, that we
Something
could
like that.
reapply for something like that and have some interim financing.
Let rates go down a little and then look for a new one.
Yes. Hopefully Chandler's projection of 2 rate drops by December will help with that determination. Sorry, Darren, go ahead.
No, not a problem. So if we turn to slide 9, just put on here a couple strategies that we're considering and that we will consider as we move forward with developing finance plan alternatives. And one of them is just analyzing the duration of our borrowing. Typically our borrowing terms are 30 years. In the municipal market, that's pretty standard. But one of the things that we may look at is, given the useful life of the project, are there potential opportunities and what are the advantages and costs of going out past 30 years? Potentially structuring debt with 35 to 40-year terms. The benefit there is obviously lower annual cost. The downside is obviously with extending out our borrowing term in aggregate over time, it's going to cost us more. Another strategy we might look at, and I kind of got to this earlier, and this is both the second and third bullets, is strategically structuring the amounts that we're repaying back in every year. We don't necessarily need 100% of the debt on an annual basis to become payable on day one. If we have a 10-year construction schedule, it's not going to be that way anyways. We would probably layer it on over time. But we can look at different debt repayment structures that if we have a forecasted revenue curve, we can make sure that our debt payments come on in a way that tries to minimize the near-term impact on rates of any debt that we need to sell. In addition, we'll look at capitalized interest. Obviously, there's benefits and considerations to using that, but it is a tool in the tool chest. And then lastly, just looking at various debt types. I think the director, you brought this up in terms of, are there ways that we can use bridge financing or short-term debt? It's absolutely something that we're going to look at. In addition, there might be opportunities where we've been talking about 30-year debt. Maybe we use some amount of short-term notes, 5, 10-year notes that allow us to get interest rates that are short on the curve. And then 5 and 10 years down the road, we just roll those notes. That's a strategy that's been used by some districts in the past when rates were higher, in a way that tries to minimize the near-term impact of this debt, obviously at the risk of, in the future, not knowing what interest rates are going to look like. But in essence, the bigger picture on this slide is that there's a lot of tools available to us, and we're going to be looking at all of these as we move forward. Any questions there?
No.
Okay. So if we turn to slide 10, I want to briefly just talk about rate reduction bonds. So this is an idea that was pitched to the district, and the district has expressed some interest in exploring the potential use of rate reduction bonds. Essentially, what rate reduction bonds are is they were put into California law in 2013 by Assembly Bill 850. And they're essentially allows California municipal utilities to issue securitized debt. We call it rate reduction bonds. What rate reduction bonds allow us to do is place a separate line item on our bill. And this line item can only be used for the repayment of the rate reduction bonds. And as long as those bonds are outstanding, this line item, this rate for these bonds, is adjusted automatically on at least a yearly basis. And then once the bonds are paid off, that line item falls off of our bill. There's certain restrictions, well, not certain, there's quite a few restrictions in terms of who can use these types of bonds. But in general, all municipal utilities with 25,000 or more customers have access to these. You have to have investment grade ratings. In addition, we do have to have certain state level approvals, such as the CPCA. Rate reduction bonds have been used in other states. Long Island Power Authority issued rate reduction bonds to refinance some of their outstanding debt. In addition, some of the IOUs in California have used rate reduction bonds for wildfire risk mitigation. And in Texas, rate reduction bonds were used to help fund some of the costs associated with Winter Storm Uri. But in California, there have been no municipal utilities to date that have issued rate reduction bonds. And so that's why, as we'll talk about, it's something that we're exploring. But it's, there's still a lot of work to be done before we know for certain whether or not this is a feasible alternative. So if we turn to slide 11, why consider rate reduction bonds?
Sorry, we have a question.
Oh, go ahead.
So, sorry, so you use in the 1, 2, 3, third bullet, you refer to this as a tariff, which is a tax. does this create any kind of 218 issues? Is there language, clear language in the legislation that these are exempt?
So these are not exempt from 218. We'll get to that and on the next slide in terms of how the 218 process and rate reduction bonds relate to each other, but these rate reduction bonds are not exempt from 218.
Seems like they'd have to provide some financial benefit to us. And just having the extra line on the bill doesn't seem very exciting to me.
So if we go to slide 11, we'll talk about the benefits. So the main benefit to rate reduction bonds is if you go back to one of our prior conversations, we were talking about the rate covenant of our just traditional debt. And our traditional debt, we have to maintain a minimum rate covenant of setting net revenues so that it's at least 1.5 times that year's debt service. The main benefit of rate reduction bonds is that the rate covenant is what we call sum sufficient. You don't need to set rates in a level to achieve anything more than 100% of the debt service cost in that year. And so to illustrate this table at the bottom of the page right here, what you'll see is that I've structured out what revenue bonds or revenue COPs would look like. This is our traditional debt. And with a $350 million borrowing, our annual debt service would be about $21.5 million per year. Now with a 125 rate covenant, that means that we would have to set net revenue or rates and charges so that net revenues were at least $27 million per year. Now, if you contrast that with rate reduction bonds, because they have a sum sufficient rate covenant, you'd only have to set rates and charges in a manner so that we were covering our debt service, or only about $21.4 million of net revenues. So you can see from a yearly basis, we're having to set our rates and charges, we can set them so that we're generating net revenues that are about $5.5 million less under rate reduction bonds versus revenue COPs. So, Director, to your question, that's the primary benefit of rate reduction bonds is they're much more efficient from that rate covenant perspective.
So whose bond is it? Who's getting the AAA rating?
So it would be the bonds, but the bonds are being issued by a JPA. But at the end of the day, it's the district that's on the hook to make the debt service payments. So it's still your debt. It's your obligation. It's just the debt itself, that bond, the rate reduction bond would be AAA rated.
But we're not able to be AAA rated otherwise?
Correct, because, well, you could be AAA rated. Right now, our revenue COP, so the domestic water fund is AA plus rated. The rate reduction bonds get a higher rating because of the way that they're structured. They're structured under JPA that's bankruptcy remote. And so because of that, as well as what we'll talk about, the way that the rates are set under 218, that allows the rate agencies to get comfortable making these AAA rated in the circumstances we've seen thus far.
All right.
Okay. So if we turn to slide 12, I want to talk about the considerations. So one of the main considerations here is that while rate reduction bonds have been used in other states, to date, there have been no California municipal utilities that have sold rate reduction bonds. So there's going to need to be a lot of substantial upfront review, research and analysis performed, not just on the financial perspective, but also from a legal and a management perspective to make sure that this is a product and a strategy that we feel is best for us going forward. Now, the second consideration here, this is what we were talking about earlier, how rates are set under 218. And so with rate reduction bonds, one of the primary characteristics is that rates are set automatically by formula. And they're set not no later, but they're set at least once a year, sometimes even more with a little bit of a true up, so that our rates are at least sufficient to pay the debt service on the rate reduction bonds. And this formula under the concept of rate reduction bond is approved under a 218 process up front, but then moving forward, the idea of rate reduction bonds elsewhere would that be we wouldn't need to go back, or we wouldn't go back and get additional approvals after this under 218. And so the benefit from a credit perspective is that the rates are being set every year to at least pay debt service. The consideration from your perspective is that that would remove board control over these future rates for the repayment of these bonds.
So for our domestic customers, we have, different rates for meter, depending on the size, and then volumetric, depending on what tier you're in and how much water you use, and on your budget. So it says remove board control over future rates. So this is a line item that's on everyone's bill, but is there some way for that line item to be proportionate to the bill?
Well,
And so
we were talking about putting the cost of Chrome 6 onto the monthly service charge so that it did not become dependent on the volumetric.
Well, I get that, but what about the 10,000 people or 20,000 people that can't afford it? Their water bill's already low, right? I mean, some people have a $200 water bill and some people have a $20 water bill. So the $20 people shouldn't pay an extra 20. And the $200 people are also just paying an extra 20. It doesn't make sense to me.
Well, but all the water has to be treated. So it doesn't make any difference how much water you use.
Yeah, but they can't afford it.
Well, so you're arguing that it should be put on the volumetric.
Well, I'm asking if there's some way to make it proportionate to the bill. You know what I mean? You mentioned a true up. So let's say that we know we collect, $100 million a year. We need 10, so everyone gets a 10% line item. And then partway through the year, you look at it, decide if it was enough or not enough, and you true it up.
Yep. I think that's part of the discussion, that if we move forward with this, the decision of within setting the rate and the formula, how is that rate set per customer in terms of volumetric versus fixed charge? And to your point, what does that mean?
That's going to be a
for
big
different classes of customer based off water usage and bill.
Yeah, because our domestic water bills vary significantly. I mean, 20 to 200 is really not it. It's a bigger range than that.
The challenge is going to be, we can't forecast, what hydrology is going to be. So we have issues, not just in canal, where we don't have any control over how much water is used, typically. But if there were to be another drought, the state would come in and tell us we need to reduce consumption. And at that point, we're now collecting less revenue towards the repayment of a bond. So
Yeah, I know. Well, the reality is we didn't really collect less revenue because we had the drought penalties. But then the question would be, would this be something that could be charged on top of that too? I mean, let's say it's 10% or 50% or whatever the number is, probably 50%. Could it be 50% of the entire bill or whatever the number is?
we can look at things, it's just a little less certain.
I just think you're going to have a real problem if somebody with a small bill pays the same as somebody with a big bill.
I agree. We're already getting some pushback from the mobile home parks because they agreed to connect to our system, and now our rates are going higher than they thought they would be. So
Yeah, I mean, I get this rate reduction. It sounds great, but I think we do need the board needs some kind of control over how it's structured in terms of who pays what.
Scott.
Well, and just to be clear, I think I'm understanding the question a little bit more. It's not as if 24 million, every single customer is going to get the same charge. You can structure it so that it's more a rate based off volumetric usage. So if someone is using less water under a rate reduction bond, they would pay less. And it's just that the formula in terms of the rate increases, if more revenues were needed, if people started using less, the rate formula would be adjusted automatically. But if I'm understanding your question, Director, it's not as if every single customer would be forced to pay the exact same amount.
Exactly, that's what I meant, yeah.
Okay, I apologize. I didn't fully understand your question at the beginning.
That's where making it a percentage of the bill would kind of fix that problem.
Yeah,
So for our low income customers, we could increase the Help to Others contribution. Currently, it's 150 a month. Or 150 annual, not a month. So we could look at increasing that. Last year, we had about 240 people participate. And the cost was 36,000.
Yeah, but can you afford 10,000 people participating?
I don't know that we would have that many. There would be an increase. I mean, if rates went up 50%, I could see it.
Yeah, no, I get it, and I think that's helpful, but we need to have some proportionality to that rate, to that charge, to the bill.
And I would point out that on the landscape accounts, a lot of those are HOAs, and that will be passed on, you know, they're high volume, and that'll be passed on to the homeowners as well.
Okay, I can see those landscape accounts coming in here and saying, I don't need you to treat for Chrome 6
Yeah.
because we don't drink that water.
Yeah,
You know,
I'll see that, yeah.
I mean, that's
We'll have
logic is
that-
out the window
we'll
on
have
this
that
whole thing.
issue.
All right, go ahead,
The
Dan.
private wells.
We need to get this
they
done.
move over to non-potable.
Yeah.
Yeah,
Private wells, yeah.
That's an internal expense that they would have to come up with a dual piping system. But we're not gonna dual pipe the entire district, just to avoid a Chrome 6 cost on an irrigation.
yeah.
Yeah.
All right, let's try to get this done. Go ahead.
Okay, I mean, that's really the end of the presentation. I think the big takeaway here is that the rate reduction bonds provide some benefits in terms of efficiency from a rate setting perspective. But there's some considerations that if we want to move forward with this as an alternative, that the entire finance team would need to think through as we move forward.
Great, we do something.
So what I'm hearing, because we want to make sure we're utilizing our time appropriately with our consultants, do you want us to continue to explore some of these questions further on the rate reduction bond? Maybe have Stradling on the call during our next meeting to talk about some of the legal up to 18 requirements before, we just drop the potential of a rate reduction bond altogether?
Well, it makes me a little nervous that nobody has issued
Oh my
one of these, and being the first out the block, just doesn't mean we shouldn't do it, but I think it takes a much deeper look.
There's a reason no one else is doing it.
I know, that's what makes me nervous.
Yeah, and I think just to put some context behind that, 'cause that's a great question. One of the reasons, at least in my mind, that it hasn't been used to date is that this is really a product that for a wholesale water entity, a rate reduction bond becomes incredibly complex because of the 218 requirements. And so this is really more relevant to retail agencies. And to date, I don't think we've seen too many retail agencies with the project size that would make this beneficial. So I'm not minimizing the fact that no one's done it before. And it would be, a kind of a lot of work to make sure it works for us. But I think that's important context of terms of where have the large projects been done and with the wholesalers. This isn't really a product that makes a whole lot of sense right now.
Yeah, I mean, the most attractive one is this SRF. Like catnip. I know we're gonna regret it later, but we at least need to look at building that part into the.
So I don't have any sense of timeline on what we're doing here. So I know we've authorized some design work and some additional research. So can somebody give me a sense of maybe big picture timeline?
Yeah. I can.
That's why we invited Carrie down and
Oh, good.
Joanne.
Carrie's been sitting there for
Meeting,
2
thank
hours
you.
and now she can
Yes.
say something.
So we currently have an RFP out to hire a consultant to do the environmental work. provide us with the environmental documents. We're drilling the wells that we need. And we're gonna move forward on a separate path with the design and construction of the wells that we need to drill to replace ones that we're taking offline. We just got the results from the JAR testing from our current consultant to make sure that the water that we plan to treat with the reduction coagulation filtration process will work. And they said that it will. So we're gonna take those results, and we already have an RFP that's drafted that we need to put out on the street to hire a design consultant that will take us through the design of the treatment plants and also to do pilot testing with the reduction coagulation filtration process. And that's probably gonna take anywhere from a year to 18 months to get those designs and completed. So I was trying to do the timeline in my head earlier too. If we get a consultant on board towards, let's just say, the end of this year, and it takes a year and a half, worst case, so we would be looking at summer of 27 when we would be starting construction on the first treatment plant. And we want to approach or we want to work on the treatment plant in the North Indio, Sun City, Del Webb area of what we call our Sun City pressure zone, because all of those wells are impacted by chromium-6. And then we have it on our schedule to then bid out the ID8 system, depending on where we're at. That may or may not happen if we work things out with Mission Springs. But that would be our second priority. And then the third and fourth would be building the treatment plants in La Quinta. But La Quinta is a very large pressure zone that where not all of the wells are impacted by chromium. So we do have 2 treatment plants to treat, 2 wells at each treatment plant in that zone. But we also are going to be looking at those wells a little closer to see if maybe 1 or 2 of them can be rehabilitated, like we did with the one in Rancho Mirage, where we look at the different, where it's screened, and see if we can potentially rehab it. So we're going to have some parallel paths, working on redrilling the wells, working on the pipe, the small amount of piping that we need, the transmission piping, and designing the treatment plants over the next 1.5 to 2 years.
So all of that's gonna be pay-go
Yeah.
until we have to issue the bonds.
And then we'll have a better idea too, once we have the pilot testing and the design underway, that consultant will give us, a revised engineer's estimate and construction schedule, and so. Does that help put things
Yeah,
in
it does.
perspective?
Yeah, it does.
And then if we do issue bonded debt, we have a 3 years, we can go back and do reimbursements if need be, or at that time, if reserves are strong, can determine that that stays as pay-go funds and just use debt issuance for future project costs.
Such a long time.
Yes.
When do we start sending out notices that we're not in compliance?
The first one will be in October, and the second one will be in January.
October of this year.
Yes, and then January of 2026.
Well, and that's just the notice of exceedance.
No, that's tier 2 notice, yes.
Notice
Of
of
exceedance.
exceedance.
Not violation.
We're hoping we won't have to send the notice of violation
Right.
if the bill passes.
And then those notices, it's just the 2 notices, or we have the continuing responsibility to notice every
We have to continue to send those notices.
quarterly basis or annually?
I think it's quarterly. join data, or is that?
Well, then we'll have to, thereafter, we'll have to include the exceedances in our consumer confidence report annually.
Okay, but there's not another mail notice that goes out to every account holder on a periodic basis.
I think
That's
there
something I
is.
think we need to check.
I think there is continuing notice, I believe.
Yeah, but I thought the language of the
We-
legislation
We,
changed.
we need to be ready, really ready with media responses and FAQs and all that stuff.
I think we already got those.
Yeah,
The city of Coachella has issued their Tier 2 notice in June.
I saw it, yeah.
And so every agency is here under the Coachella Valley Regional Water Management Group will all be teaming together so that we're consistent on our messaging. Their Tier 2 notice, I mean, so it's
Make sure the word naturally occurring shows up on it somewhere.
for sure, yes.
Okay.
And the notice language is very prescribed by the State Water Board.
I know, did I bring in the Coachella one? I'm sure you have it, right?
Yeah.
You have
We
it.
have it, yes.
Yeah.
They were able to augment language, but had to keep the standard state language.
Yeah,
And I think the state has to approve even the augmented text
Sure.
of the notice.
okay. I think we're done for today, right? Is that it?
Good meeting, yeah, thank you
Yeah,
all
thank you.
very much.
Yeah, sorry it took a little while to get started.
Yes.
And this will be posted to YouTube at some point. Because we weren't able to stream. So thanks to our consultants.
Thanks, good job.
Yeah.